Check that big board, barely showing a gain at the moment. We're pretty much flat at a gain of 4 points. But I want to return to the GDP story, the strength of the economy. In the third quarter, our economy, America's economy, grew at an annual rate of 2.9%. Sounds pretty good, but then dig deeper, maybe not so good. John Lonski is Moodys managing director. Now, he is an economist, aren't you, John?
Yes, I am, unfortunately.
Okay. Well, I don't hold it against you. I just want some truth here. 2.9% annual growth. I think the Clinton campaign will jump all over it and say, see, we've got a recovery on our hands. Do you believe that?
No, I don't at all. I mean, that number was swollen, distended by the big gain in inventories and a narrowing of the trade deficit. If you take out the change in inventories and take out the drop in the trade deficit, growth comes back to the 1.4% that we had the previous quarter. So it didn't change at all. If we're looking at domestic spending and final goods and services, the economy still is very flat, and by no means is it growing close to 3% on a sustainable basis.
We had Steve Moore, who is an advisor to the Trump campaign, who was on the show earlier. He tells us that there's not been a single year in the past 10 years where America has achieved 3% growth. It's always been below 3%.
Got to go all the way back to 2005 to see 3% growth. That's correct. And I will add, over the past 10 years, the average annual rate of real GDP growth is a puny 1.3%. That is the worst 10-year performance since 1939, when the economy, when it grew by 1% annually on average.
Is this the primary reason, this really, really slow growth over many, many years? Is that the primary reason for the pinching of the middle class, the shrinking?
Definitely.
Of the middle class?
The opportunities people used to have in the past to go ahead and advance aren't there anymore. When you have growth, 3 to 4%, that provides some from the middle class, that opening of the window that allows them to move up. It's not happening.
Can I ask you about Amazon? I'm not asking about the stock in India. I know you don't do that kind of thing. But look, the stock is way down, $38 lower. I say that company is being badly treated by the analysts. They're saying, Wall Street is saying, oh, you missed expectations, so we take you down, even though they're investing heavily in their own company.
I agree with you 100%. Their revenues are growing, what, 25, 26%?
Yes, huge.
Believe me, it's a lot easier to cut costs than it is to grow revenues. They're having such success at growing revenues. Focus on that. Eventually, they'll get control of costs, the margins will widen, and shareholders will be very, very happy. On the capital spending front, may I add one thing?
Yeah.
I'm looking at some recent data for non-financial corporations. It's stunning. Over the past year, I think about 77% of capital spending, we could equate that to equity buybacks and dividends. The ratio of dividends and equity buybacks, CapEx, 77%. Years ago, that average used to be about 1/3. That's how the world has changed.
But Amazon is doing the exact opposite. That's capital spending.
That's how you grow companies. That's how you grow the economy.
You know, Lonski, you can come back.
Well, thank you.
You might not want to, but you can. John Lonski, everyone. He's good. Thanks very much, John. All right.